And this brings me to number 3, build the right plan and build the right team. Starting with your team, you want to look for the 3 A's. Number 1, you want to have a good attorney. Number 2, you need to have a good accountant. Number 3, optional, you want to have a good financial advisor as well. Your attorney is going to protect you with whatever you're doing. If you're investing in real estate, they're going to help you draft the contracts. You're dealing with tenants, they'll help you draft the lease. If you're investing in building a business, if you're investing in real estate, you want to have good entity protections. They're going to be there to protect you legally. And even if you're not investing in real estate, a good estate planning attorney can help you organize your assets. That way your estates, your assets can pass on even after you die. Secondly, a good accountant. As you invest your money, what you're going to realize is that our tax code is designed to favor investors. But in order for you to take advantage of these tax advantages, you need a good accountant that can help you with that. If you're just working a job, a W-2 job, having a high-paid accountant isn't really going to do you that good because you qualify for the least deductions and there's not much you can do. But as you start investing your money, well, now you start to open up the door for more potential tax breaks. If you start investing in real estate and start a business, well, now you have more potential tax opportunities. And this is where especially you're going to want to have a good accountant on your side that can help you limit your tax liability. Number 3, having a good financial advisor, especially if you don't want to be in the business of investing your money yourself, or if you have money to invest and you want an additional set of eyes to look at what you're doing. This is where a financial advisor can be very handy because now they can work with you on your personal financial situation. They can learn what your goals are and work with you to build a plan to have the financial freedom based off of what you want. Now again, not all financial advisors are good. Not all accountants are good. Not all attorneys are good. Some are going to be good, some are going to be bad. You want to find a good one for you. And again, if you're looking for a good financial advisor, you can check out our sponsor Money Pickle to be connected with one with a free consultation. I got their link down in the description. From there, a couple other people that you want to think about on your team are getting a teacher. So if you're investing in stocks, you're investing in real estate, one of the things that you can do to lower your mistake curve is to learn from somebody who's done it. You can start by watching YouTube videos. You can start by reading books. Then you can also buy some classes, potentially get some coaching if that's something that is valuable to you. But there's a lot of resources online, understanding that you can learn from somebody else's mistakes. That way you can make less expensive mistakes so you can get to where you want to go faster and with less problems and less hiccups. That's the goal with a good teacher. Of course, there are some bad teachers out there, but just study who you're learning from. And then of course, ask that team. So if you're investing in real estate, you got to have a good property manager, you need a good contractor, you need a good accountant, you need a good attorney, you need a good insurance broker. There's a lot of people that you need. So depending on what assets you're going to be investing in, you need a good team to support you in that. And the second part of this, of building the right plan, is knowing what it is that you want to invest in, especially as you're investing your money yourself. Because when you invest your money in a 401k, you're very limited. You can invest your money into a certain number of funds, which are going to give you exposure to the stock market. But as you invest your money yourself, where are you going to invest your money? Is it stocks or is it real estate? These are 2 asset classes that have built more wealth than anything else over the last century, plus building a business, but that's a little bit different. So when it comes to stocks or real estate, what's better for you? You could do both, but you got to do at least one of these 2 things because these have been proven to build more wealth than anything else over the last century. When you invest in stocks, you're investing in the economy. You're investing in companies that are selling things in our economy. When you invest in real estate, it's a little bit different because now you're operating the property itself. If you were to go out and invest in the Amazon company, there's the CEO of Amazon and all the employees at Amazon that are working to run the company. If you go out and buy a property, now you're the CEO, you're the one that's running the deal. You can hire a property manager, you can hire a contractor, you can hire people to do the work, but you're operating it. Plus, when you invest in real estate, you own something physical, something that you can see, feel, and touch. Versus with stocks, when you invest in Amazon, you get a paper certificate, which says you own a little bit of Amazon. If you walk into the Amazon warehouse and ask for something, they're not going to know who you are and they're not going to care. Versus when you own the property, you own the property. It is your deal. You manage it. The risks fall on you. But you can also see more potential upside because now you can control how you manage it. You can change the landscaping. You can fire the property manager. You can do things to change the way you run the business versus you can't do that here when you invest in stocks. Number 4, let's talk about some of the ways that you can boost the returns that you get. Now the obvious part to this is you can invest your money and get a better rate of return. Instead of getting a 7% return, you get a 15% return. That's obviously going to increase your returns because, well, it's a higher return. But what about the alternative? Because the alternative is you can lower your fees. If you're investing your money into a 401k, into an IRA, into an ETF, into an index fund, into a mutual fund, there are fees that you have to pay, and this fee is called an expense ratio. And this expense ratio could be costing you millions of dollars over the course of your career. Let me show you what I mean. If you were to invest $1,000 a month and you do this for the next 40 years, assuming you can grow your money by 10% a year, and you have a small little 1% fee, how much is the small little 1% fee going to cost you? Well, based off of this example, this 1% fee is going to cost you over $1 million in fees going straight to your money manager. And so the question you want to ask is, are there ways for you to get similar returns while paying a fraction of those fees? And this is where you want to understand the difference between an actively managed fund and a passively managed fund. An actively managed fund is when you invest in something that is managed by a person, and their goal is to hopefully get you better returns. A passively managed fund is when you're investing in a fund that's managed by a computer, by an algorithm, and the fees are a lot less because you don't have to pay for that person. Now, what we've seen throughout history is that if we look at it over a long enough period of time, the passively managed funds generally outperform the actively managed funds, especially after you factor in the fees. Warren Buffett did a test on this where he bet against some of the highest paid money managers, some of the best money managers in the game. And what he said is if you put your money into a low-cost index fund, you would outperform the money managers. He put a $1 million wager down, and over the course of 10 years, Warren Buffett won. So, what does this mean? Sometimes an actively managed fund might be better. Other times a passively managed fund might be better. But what you want to know is what's better for you. And so if you can find a way to invest in funds that are paying lower fees, that means you can keep more of this money in your pocket. And if you're going to be investing your money into a higher fee fund, make sure that the returns are justifying the higher fees. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.